Picture this. Somewhere in a glass tower in London, a trader just watched his screen flash red. Not the usual red, the kind of red that makes your stomach drop. The kind that means the algorithms aren't working anymore. The kind that means the game just changed. For decades, they've controlled it. The big banks, the market makers, the institutions with names you'd recognize. They've had their hands on the wheel, steering prices exactly where they wanted them to go. Up a little when it suited them. Down a lot when they needed to shake out the weak hands. It was predictable. It was manageable. It was controlled. Until now, something broke. And I'm not talking about a temporary glitch or a bad trading day. I'm talking about a fundamental shift in the market structure that's been building for months, hidden beneath the surface, and it's finally erupting in a way that has some of the smartest people in finance genuinely concerned. Let me show you what's happening right now, because this isn't just another price spike. This is a squeeze. A real one. The kind that happens when the physical market and the paper market finally collide, and one of them has to give way. Start with the basics. For years, the precious metals market has operated on a simple principle. For every ounce of physical metal that exists, there are dozens of paper claims on that same ounce. Futures contracts, ETF shares, allocated accounts, unallocated accounts, derivatives stacked on derivatives. It's a system that works beautifully as long as everyone plays along, as long as nobody actually wants to take delivery of the physical metal. But what happens when they do? That's the question keeping traders up at night right now, because something unprecedented is happening. The demand for physical delivery is surging. Not from retail investors buying coins, not from jewelry manufacturers, from the big players, the ones who move markets, central banks, sovereign wealth funds, major institutions. They're not buying paper anymore. They're demanding the real thing. Look at the COMEX warehouse data. The registered inventory, the metal that's actually available for delivery, has been draining at an alarming rate. We're talking about levels we haven't seen in years. Every month, more metal leaves than comes in. Every month, the cushion gets thinner. And every month, the number of paper claims on each remaining ounce gets larger. It's a mathematical problem. And mathematics doesn't care about your trading algorithms or your market manipulation strategies. When the numbers don't add up, something has to break. Here's where it gets interesting. The banks that have been managing this system, they're not stupid. They saw this coming. They've been trying to manage it, raising margin requirements, changing contract specifications, encouraging cash settlement instead of physical delivery. Every trick in the book to keep the paper market functioning without having to actually deliver metal. But the market is calling their bluff. Think about what happened in the nickel market a few years back. The London Metal Exchange had to halt trading because a massive short squeeze threatened to bankrupt one of the biggest players. They literally changed the rules mid-game, canceled trades, gave the shorts time to cover. It was unprecedented, it was controversial, and it showed everyone watching exactly what happens when the paper market loses touch with physical reality. Now imagine that scenario, but in a market 10 times larger, a market that's not just about industrial metal, but about monetary metal, about wealth preservation, about central bank reserves, about the very foundation of the global financial system. That's what we're looking at. The squeeze isn't just about price, it's about control. For decades, the ability to influence precious metals prices has been a tool of monetary policy. Keep gold and silver prices suppressed, and you maintain confidence in fiat currencies. Let them run, and you risk a crisis of confidence in the entire system. It's why central banks lease gold. It's why bullion banks hold massive short positions. It's why the paper market exists in the first place. But control requires ammunition. It requires physical metal to back up the paper promises. And that ammunition is running low. Look at what's happening in the physical market right now. Premiums on coins and bars are elevated. Delivery times are extending. Refineries are running at capacity. The spread between paper prices and physical prices is widening. These are all symptoms of the same disease, a shortage of available metal relative to demand. And the demand isn't slowing down. It's accelerating. Central banks bought more gold last year than any year since 1967. Let that sink in. We're talking about a level of accumulation that predates the end of the gold standard. Countries that have historically held minimal reserves are suddenly buying aggressively. China, Russia, India, Turkey, Poland, Singapore. Even countries you wouldn't expect are quietly adding to their stockpiles. Why? Because they see what's coming. They understand that in a world of unlimited money printing, of negative real interest rates, of currency wars and trade wars and actual wars, Physical metal is the ultimate insurance policy, and insurance is only valuable if you actually have it when you need it. The paper promises won't help you when the system is under stress. The allocated accounts won't help you if the bank that holds them is in trouble. The ETF shares won't help you if there's a redemption crisis. Physical metal in your possession or in a vault you control, that's what matters when things get real. And things are getting real. Consider the supply side of this equation. Mine production has been essentially flat for years. The easy deposits have been found, the high-grade ore has been extracted. What's left requires more energy, more capital, more time to bring online. And with energy costs rising, with environmental regulations tightening, with permitting processes taking longer, new supply isn't coming to market fast enough to meet demand. Recycling can only do so much. Industrial demand keeps growing. Technology demand keeps growing. Investment demand is surging. And now you add central bank demand on top of all that. The math doesn't work. Something has to give. Either prices have to rise enough to destroy demand, or supply has to increase dramatically, or the paper market has to decouple from the physical market entirely. That last option is what's starting to happen, and it's what has the banks worried. When paper and physical prices diverge significantly, it creates arbitrage opportunities. Buy the paper, take delivery, sell the physical. Simple, profitable, and absolutely devastating to the banks holding short positions. Because every delivery demand drains the registered inventory. Every drain makes the next delivery harder. Every difficulty increases the pressure on the shorts. It's a feedback loop, and feedback loops in financial markets tend to accelerate until something breaks. Now, let me pause here for a moment because this affects a lot of people differently depending on where you are in life. If you're sitting on retirement accounts, if you've got 6 figures or more in traditional investments, this kind of market dislocation creates both risks and opportunities. I put together a comprehensive guide on how gold IRAs work, how you can get physical metal into your retirement accounts without triggering tax penalties, how the mechanics actually function. It's free. It's in the description below. Worth looking at if you're thinking about how to position yourself for what's coming. No pressure, just information. Back to the squeeze. The banks are in a corner. They can't deliver metal they don't have. They can't buy metal without driving prices higher. They can't close their short positions without triggering the very squeeze they're trying to avoid. Every option leads to pain. So what do? They try to manage it. They try to slow it down. They try to buy time. But time is running out. Look at the open interest in the futures market. Look at the ratio of paper claims to physical metal. Look at the delivery demands. Look at the warehouse stocks. Every metric is flashing warning signs. Every indicator suggests the system is under stress, and stress creates volatility. Volatility creates fear. Fear creates demand for safe havens. Demand for safe havens increases the pressure on the physical market. Round and round we go. The really fascinating part is watching how different players are positioning themselves. The smart money, the people who understand market structure, they're not waiting for the squeeze to fully develop. They're positioning now. They're taking delivery now. They're moving metal into private storage now. Because they know that once the squeeze really gets going, once the panic sets in, it'll be too late. Think about what happened in 1980. Gold hit $850 an ounce, which is over $3,000 in today's dollars. Silver hit $50, which is over $180 adjusted for inflation. Those weren't gradual moves. Those were parabolic spikes, driven by a combination of inflation fears, geopolitical tension, and a massive short squeeze in the silver market. The Hunt brothers tried to corner the market, and they nearly succeeded. It took coordinated intervention by the exchanges and the government to break that squeeze. Could it happen again? The mechanics are different, but the fundamentals are similar. You have massive paper positions. You have limited physical supply. You have growing demand. You have geopolitical uncertainty. You have currency concerns. All the ingredients are there. The difference this time is the scale. The derivatives market is larger. The paper claims are more numerous. The leverage is higher, and the potential consequences are more severe. When the nickel squeeze happened, they could halt trading because it was one market, one exchange, one metal. When a precious metals squeeze happens across multiple exchanges, multiple countries, multiple markets simultaneously, what then? You can't halt the entire global monetary system. You can't just cancel trades when central banks are involved. You can't change the rules when sovereign nations are demanding delivery. This is why the banks are worried. This is why the control is slipping. This is why we're seeing price action that doesn't follow the usual patterns. The algorithms that have managed these markets for years, They're based on historical patterns. They assume certain relationships hold. They assume the paper market leads the physical market. They assume delivery demands stay within normal ranges. They assume the system functions as designed. But what happens when those assumptions break down? What happens when the physical market starts leading the paper market? What happens when delivery demands exceed available supply? What happens when the system stops functioning as designed? You get a squeeze, a real one, the kind that makes history. And we're watching it develop in real time. Look at the price action over recent months, the volatility, the sudden spikes, the sharp reversals, the overnight gaps. These aren't normal market movements. These are the signs of a market under stress, a market where the usual controls aren't working, a market where something fundamental is changing. The banks are trying to manage it with every tool they have. Raising margin requirements to discourage speculation, encouraging cash settlement to avoid delivery, leasing metal from central banks to meet delivery demands, coordinating with other banks to share the burden. Everything they can think of to keep the system functioning. But there's a limit to what they can do. There's a limit to how much metal they can lease. There's a limit to how high they can raise margins before they destroy liquidity. There's a limit to how much they can coordinate before it becomes obvious manipulation. And they're approaching those limits. The physical market doesn't care about their limits. The physical market is governed by supply and demand. And right now, demand is overwhelming supply. Think about the industrial users, the manufacturers who need silver for solar panels, for electronics, for medical applications. They can't just stop production because the price is rising. They need the metal. They'll pay what they have to pay. And when they start competing with investors and central banks for limited supply, prices have to rise. Think about the jewelry market, the cultural demand in India and China, the wedding season demand, the festival demand. These aren't discretionary purchases that disappear when prices rise. These are cultural imperatives. These are traditions that span generations, and when that demand meets investment demand, meets industrial demand, meets central bank demand, something has to give. The banks thought they could manage it. They thought they could use the paper market to satisfy demand without actually delivering metal. They thought the system would hold together as long as confidence remained. But confidence is cracking. Every time a major institution demands physical delivery and gets it, it proves the metal exists. But it also reduces the available supply for the next delivery demand. Every successful delivery makes the next one harder. Every drain on inventory increases the pressure on the system. And the institutions know this. They're not stupid. They see the same data we see. They understand the same dynamics we understand. And they're acting accordingly. This is why you're seeing unprecedented demand for physical metal. This is why premiums are elevated. This is why delivery times are extending. This is why the squeeze is building. The banks lost control when they let the paper market get too far ahead of the physical market. They lost control when they allowed the leverage to build to unsustainable levels. They lost control when they assumed the system would always function as designed. But systems break. Markets break. Control breaks. And when it breaks in a market as important as precious metals, the consequences ripple through the entire financial system. Think about what precious metals represent. They're not just commodities. They're not just industrial inputs. They're monetary metals. They're stores of value. They're insurance against currency debasement. They're the foundation of central bank reserves. They're the ultimate safe haven in times of crisis. When the price of that insurance starts rising uncontrollably, when the availability of that safe haven becomes questionable, when the foundation of central bank reserves becomes unstable, it calls into question the entire monetary system. This is bigger than just a price squeeze. This is about confidence in the system itself. The banks understand this. The central banks understand this. The governments understand this. That's why they've worked so hard to maintain control. That's why they've built such an elaborate paper market structure. That's why they've fought so hard to keep prices manageable. But the market is bigger than any institution. The market is bigger than any government. The market is the collective action of millions of participants making billions of decisions. And when the market decides something is undervalued, when the market decides something is scarce, when the market decides it wants physical delivery, no amount of paper manipulation can stop it. We're watching that play out right now. We're watching the market reassert itself. We're watching the physical reality overcome the paper fiction. We're watching the squeeze develop. The question isn't whether it will continue. The fundamentals guarantee it will continue. The question is how far it goes. How high prices rise. How much stress the system can take before something breaks. History suggests these squeezes can go further than anyone expects. The 1980 spike, the 2011 run. The moves were larger and faster than the experts predicted. The pain for the shorts was more severe than the models suggested. The disruption to the market was more significant than the authorities anticipated, and this time the setup is even more extreme. The leverage is higher. The physical shortage is more severe. The geopolitical tensions are more acute. The currency concerns are more widespread. The central bank demand is more aggressive. Every factor that drives a squeeze is present and intensifying. The banks know this. They're not blind, they're not incompetent, they're trapped. Trapped by positions they can't easily exit. Trapped by a system they helped create. Trapped by market forces they can no longer control. And when major financial institutions are trapped, when they're facing losses they can't absorb, when they're staring at a squeeze they can't stop, that's when things get really interesting. That's when the authorities step in. That's when the rules change. That's when we find out what really matters in the financial system. But here's the thing about rule changes. They only work if everyone agrees to play by the new rules. And when you're dealing with sovereign nations, with central banks, with major institutions around the world, getting everyone to agree becomes complicated. Getting everyone to accept paper settlement when they want physical delivery becomes impossible. This is the corner the banks have painted themselves into. This is the control they've lost. This is the squeeze that's developing. And it's just getting started. The price action we're seeing now, the volatility, the spikes, the stress in the market, this is the early stage. This is what it looks like when control starts slipping. This is what it looks like when the paper market begins to crack. Wait until the physical shortage becomes undeniable. Wait until the delivery defaults start. Wait until the premiums explode. Wait until the two-tier market fully develops with paper prices and physical prices diverging significantly. That's when the real squeeze happens. That's when prices go parabolic. That's when the banks face their reckoning. The smart money is positioning now. The informed investors are taking delivery now. The institutions that understand market structure are securing physical metal now, because they know what's coming. They've seen this movie before. They know how it ends. The banks lost control the moment they let the paper market become disconnected from physical reality. They lost control the moment they allowed leverage to build beyond sustainable levels. They lost control the moment they assumed the system would always function as designed. Markets have a way of finding the truth. Markets have a way of exposing fiction. Markets have a way of forcing reality on those who try to deny it. And the reality is simple. There isn't enough physical metal to satisfy all the paper claims. There isn't enough supply to meet surging demand. There isn't enough control to prevent the squeeze. The banks know it. The market knows it. And soon, everyone will know it. The squeeze is here. The control is gone. And what happens next will reshape the precious metals market for years to come. This is the moment we'll look back on and recognize as the turning point. The moment when the paper market finally gave way to physical reality. The moment when decades of price management came to an end. The moment when the true value of monetary metals reasserted itself. The banks just lost control, and there's no getting it back.